Definitive Cam Co. by Stephen Rand, Catherine Smith, Jordan T. Borden, and Carla Bowles. About Definitive Cam Co. We're headquartered in the United States. Our modern production facility located in Taiwan, which assembles all of our cameras. Graphical locations: Latin America, North America, Europe, Africa, and Asia Pacific. Our team of co-managers took over operations at the end of year 5. Our main objectives. Our main objectives were to oversee and maintain a growth of EPS by 8%, see our ROE at 15% or more annually, see our stock prices gain average 8% through year 10 and 4% thereafter. We wanted to maintain a minimum credit rating of a B+, and then keep our image rating at 70 or higher. Our SWOT analysis. Our strengths included financial resources, economies of scale, highly skilled workforce. Some of our weaknesses was lack of product differentiation, an average market image, and then a weak global market strategy. Some opportunities we saw was expanding product lines, increasing sales in weaker markets, demand. Some of the threats were increasing customer buying power, popularity of a substitute product, and equally balanced competitors. Our Porter's 5 forces. Our barriers to entry was considered high, with capital resources and economies of scale. Intensity of rivalry was relatively strong. We had many equal competitors, lack of differentiation offset by fast industry growth. Our substitute product was relatively few, as there are smartphone cameras and analog film cameras. Power of our buyers was strong, easy to change brands, and then no switching costs. Powers of suppliers were relatively weak. There's decreasing core component prices and steady price brand components. Industry attractiveness was moderately high. We had high barriers to entry, weak rivalry, a few subs with weak suppliers, and then strong buyer power. Here is an example of what I just went through. It doesn't include all the detail, but it shows on a scale of where we thought we stood. Recommendations. Increase efforts to strengthen company's image through advertising and sales promotion. Differentiate products from competitors with extended warranties and tech support. And adopt a more global marketing strategy, increasing investments in weak and intermediate markets.
Hi, I'm Stephen Rand. I'm here to talk about our strategy. So ultimately, our grand strategy was we wanted a combination of growth and stability. To get the growth going, we knew that we were going to have to market heavily in our weakest market, which was Asia Pacific, but we also wanted to make sure that we didn't lose any of our good Latin America. And then also stability was going to be very important for us. We needed to make sure our share growth, our stock was going up along with that, and then our revenues were always increasing at least at the market rate of 8 to 10%. Now, market penetration was going to be very important for us. Like I said, we knew we needed to invest heavily in Asia Pacific. That was our lowest volume market, and then we didn't want to lose anything in Latin America. And ultimately, what we wanted was to grow international markets to a consistent size and market share so we could have one global strategy and not have to waste management resources creating 4 different strategies for every market. And you can see by year 13, combined entry-level and multifunction were between 51 and 53% in every international market. And so, we wanted to have a global international strategy. As I said, standardization of products, standardization of services, and operations centered around a few locations. Now, here's where I really think we wanted to be a best cost provider. We kind of wanted to follow the Walmart strategy of creating low prices with the economy of scale that competitors would struggle to compete with. And so we knew that we were going to have to invest heavily early in production facilities, R&D, and employee training. Next, we knew that we'd have to price our camera really low at a very slim profit margin. Now, to be able to achieve our profit goals at a small margin, we're going to have huge volume. So it's important to get to stimulate sales. And then as we develop the economies of scales, we continue to lower our prices and get to a point where our competitors cannot economically compete with us, but we could still be growing profit margins. And ultimately, this would force our competitors into niche markets that would really limit their potential. So for our entry-level camera strategy, we knew we wanted to maintain that, but we could use our research and development and productivity gains and labor efficiency to drop our production prices, and continue to drop the price to customers on that. And on top of that, we wanted to still have tech support and a very solid warranty. Our multi-feature strategy changed slightly. What we wanted to do, instead of maintaining a similar quality but drop, we wanted to maintain price while increasing quality. And we're going to again do this by capitalizing on our productivity and decreasing component costs. And then we knew it was going to be even more important on the multi-featured strategies to have large tech.
Okay, on production strategy, to be the best cost provider, we knew we'd have to have an aggressive production strategy. So our three principles are basically reward our workforce with leading compensation, including bonuses and fringe benefits, invest in research and development and our PAD productivity training, and adding workstations to maximize production capabilities. And then, in order to avoid outsourcing, use temporary PAT workers and overtime of the regular workers to meet our third quarter production peaks. And so we increased our PAT workstations. In year 6, we increased from 100 to 210, doubling our capacity. We went to 260 workstations, and by year 9 had 310, tripling the capacity since we took over management. And here you can see our company was the industry leader for salary, and by doing that we increased our productivity every single year. So we went from 2671 in year 6 to 5987 in year 13, and we were the industry leader for productivity every year. Our financial strategy involved our debt to equity ratios, how we dealt with our stock and repurchases, our dividend payments to shareholders, plus paying down our line of credit to improve our credit rating. Here's our debt to equity ratios. As you can see, our equity is increasing and the debt is decreasing in every year. So we started with a 25-75 ratio. It finished with an 18-82, a very strong debt to equity ratio. Okay, our stock policy was basically, as far as new shares issued, we did in the first year money for investment, and in subsequent years, just shares to help boost our stock price. And that increase in stock price was the benefit that offset our dividend policy, which was a little low compared to industry average. A dividend in every year. And a comparative ratio now. We were ahead of the industry average in EPS, return on equity, profit margin, and net profit margin. And our production costs were high, but they were still less than in our delivery, marketing, and overall total administrative costs were low. Our liquidity ratio, it was the industry average, right at 2.4. The dividend payouts were low compared to industry average. But we did very well with our credit rating. So, both with also percent. The times interest earned is very strong at 36.6, and our debt payback is in less than 1 year, only 0.8. So,
Okay, my name is Monica. I'm here to talk about the net revenue and EPS. We actually achieved continuous long-term growth in every section of net revenues and EPS. As you can see at the bottom, the investor expectation is actually at about the $2 mark and slowly rising up to the $4 mark, while we started at investor expectations. For our ROE and stock, we met or exceeded investor expectations in both categories every year that the co-managing group was in charge. With ROE, we started at about a 15%, and while that stayed consistent at 15% investor expectations, we actually raised up to almost 50%. For our stock prices, we also started at about $25 or so there, and it raised all the way up to almost $160. While at the end of year 13, our investor expectation was only about $45 to $60. For our image and credit rating, we started a little bit lower taking into year 5 for image rating. We slowly boosted it into the 90s, and then after about year 10, we consistently kept it at 100. As far as our credit rating, we did have a couple lower years in 9 and 10, and then we continued to increase it to the A credit rating down from about B. For our year 14 performance targets, we assumed that we could get the 100 image rating again. We could get our credit rating up to an A+, keep our net revenues around the $665 to $735 range, keep our earnings per share $12 to $13, our ROE at 50 to 55, and the stock price about 170 to 190. All of those are very achievable considering how far we've gotten already, and it would be easy to maintain and grow them. For our competitors, the entry-level camera and how everyone stacked up, everyone tried to have a higher priced but yet lower priced entry-level camera, in which company D got the lowest price camera. We did keep a lower warranty on it and fewer level of models, but our P&Q rating was in the middle range. We did have higher promos, and we controlled the 55 to 63% of the market share compared to anywhere from 8 to 17 or 20% for the rest of the competitors. For our multi-featured camera, we kept a mid-range price group, so we weren't. Company B was the highest at $525 to $553, and Company A was the lowest at $380 to $390. We were right in the middle at $425 to $445. We kept with a 3-year warranty just like everyone else. We continued to stay with our 4 models, and we had almost the highest P&Q rating at 4 stars. We continued to dominate the market share in our multi-feature camera section as well, with our strong promotions and our affordable pricing. For strategies to remain the industry leader coming into year 14, we planned on expanding our entry-level cameras from 4 to 5 models, while keeping the P&Q rating at 2 stars, and we would try to decrease the price at a rate that competitors could not economically compete with. For a multi-feature camera, we would want to increase P&Q from 4 to 4.5, but keep the prices around that same affordable price. Our lessons learned were always analyzing the competitors before making the decisions, and staying consistent with our strategies. We found that when sticking with one strategy and growing off of it, we did better than trying to scatter our way around multiple strategies. As far as analyzing our competitors, it was easier to see what everyone else was doing and grow off of that, but then also being independent and having our own designs.
So ultimately, in the end, Definitive Camco proved that you can be a low-cost provider, but still treat your employees great and really have gains in productivity and not just from paying low labor. And really that's what we're most proud of is, yes, we dominated market share, but we also took so much better care of our employees than our competitors. Thank you for listening to our presentation. And really that's what we're most proud of.